Perspective.
I have my screen shared with you. Can you all see my screen?
Yeah.
That's good. So today we are going to talk about financial statement analysis. That's what the chief examiner wants us to do for today. Financial statement analysis. From the earlier lecture, from last week's lecture, we were able to do a number of things, including how the financial statements are prepared. And I showed you a financial statement prepared by Guinness Ghana Company, the layout. We understood that the financial statement is prepared on the basis of what is called the accounting equation. Asset is equal to capital or equity plus liabilities. And then we also demonstrated we demonstrated how a typical balance sheet or statement of financial position looks like, which supports or which confirms that it is prepared on the basis of the accounting equation. We also looked at the layout of a financial statement, but for review, let's try to take ourselves through those things, because our understanding of what we are to do today depends so much on what we did last week, most especially the financial statements preparation. We did not necessarily take ourselves through the rigor of preparing financial statements. We didn't do that. We just demonstrated how a prepared financial statement, notably the income statement and the statement of financial position, look like. And then we try to get the understanding of the financial statement elements which forms the statement. So everybody here, when you see a financial statement, you should have some good understanding of the meaning of the items in the financial statements and the values assigned to them. You should have that basic understanding. What we are going to do today to add to that one is, once you have the financial statements, whether prepared by yourself or prepared by a machine, you should be able to do some analysis of what you are seeing. The analysis is supposed to inform you, give you insight into what is happening to direct your decision making. You remember all the things we were saying were bordering on decision making. We said that the information that is produced by the accounting information systems in the form of the financial statement is to assist users' decision making. So when you get a financial statement for your decision making, you should be able to do a few computations, look at few things to tell you that this is what is happening and this is what I have to do. That's basically what we are going to do today. The reason why this is important is, please get your microphones off, I beg you. If I see anybody not conforming to the rules, I'll take the person out of the class. It's as simple as that. Ezekiel,
Sir.
Please, we don't need your mic to be
Hello,
on.
sir.
Put it off.
Sir. Yes, I'm working on it, sir. I'm putting it.
Emmanuel Opoku, put your camera and your microphone off. We don't need your camera. We don't need to see your face for anything. Stephen, Your camera should be off. We don't need to see your face for anything. Mr. Eric Amuzu, your camera is still on. What do you need to see through the camera? There should be discipline among us. When we say we are doing this, please let's all comport ourselves and do it. There's a reason why we should have those things off. Can you see my screen? Hello, can you see my screen?
Yes, sir. We can see your screen.
No, please.
Okay, thank you very much for seeing my screen. So we are talking about financial statement analysis. And the reason why financial statement analysis is important can be many. One, I know that some of you, if not all of you, are currently investors. Or you may be potential investors. You may be interested in one day investing in some venture. And when you get financial statement from the people running your investment, you should be able to understand what is happening, how they are doing things, and whether it makes sense for you to still keep your investment in such a company or de-invest, sell your investment. If you are a potential investor, whether you should in the first place think of bringing your money to such a company or think about a different alternative. If you are a bank which is into credit granting, the financial statement analysis will help you whether this is a company worth giving credit to or not, and so on and so forth. So it's very, very important at that level. Even at personal level, financial statement analysis. In your home, you have some financials. You can employ the tools we are about to learn here in assessing few things to see whether things are going right or wrong. Okay. Before the financial statement analysis proper, let's review the financial statements, how they appear when they are prepared. We are starting from statement of comprehensive income, also known as the income statement. If you look at a typical income statement, this is what you will see. You will see the elements of the income statement made up of revenue or income. So we have revenue. This is sales revenue. The new standard on revenue wants us to title it revenue from contract with customers. So it's simply revenue. Then you will see the year of reporting. In this case, it is 2019. And you can all see the 2019 there. 2019 is the year of reporting. And then they bring the previous year as a comparative year. So this is how traditionally we present our company's financial statements. And then you also
Sorry,
see
sir.
this.
I can't see like your presentation. I don't know on the screen.
Who can see the presentation, please? Hello?
I can see the presentation, but it is in a smaller
It has been minimized.
not legible enough. I don't know whether we have to increase.
No, the size of it may depend on your own device. If you are you using a phone?
Yeah, I can't.
I am using a laptop, but the screen is small at the corner, and the people or the participants' faces are at a particular place.
Okay. Let me see.
Sir, I can also see the screen. I can see now, but the size is so small. So as you said earlier on, it depends on your device.
Can you see full screen now?
Sir, we can see
Yes,
full
yes, yes. We can see the full financial statement analysis.
It's okay now.
It's okay now. Thank you very much.
It's okay now.
Okay, so we were talking about how financial statements appear, how they, the form that they take. We are taking them, in fact, we are going to concentrate on the two main financial statements, the income statement, also known as the statement of comprehensive income, and the balance sheet, also known as the statement of financial position. Now we are on the statement of comprehensive income. This is how it appears. You see the elements, the year of reporting, and a comparative year. The elements basically are, as we learned last week, revenue and expenses. So let's see how they feature. So we have revenue from contract with customers. That is the main revenue coming from the operations of the company. So you'll see the figure here. The reporting period is 2019. So the figure for 2019 and the figure for the comparative year. And another important feature to note is the note. Sometimes, and we say that for financial reporting purposes, which is more externally focused, we summarize the things. So the details are hidden. So those who may be interested in some level of detail, you will see the note which is attached here, note 6. So if you go to the note section of the financial statements, let's scroll down. Okay, so I think the note starts from okay, this is where the note starts. Notes to the financial statement. General information. Summary of significant accounting figures, they are all there. Then you come to the actual note numbers. Okay, so these are all preliminary things. Actual note numbers. Let's go to note 6. If you go to note 6, you will see note 6 is talking something about revenue. Note 6. Let's try to see note 6. And the notes can be very voluminous because it's trying to explain all the things that we have abridged. So note 6. This is note 6. Revenue from contracts with customers. And then you see some level of detail. Let's see the detail they are trying to give us. Revenue recognized at a point in time, and then revenue recognized over time. If you read the standards on revenues, it specifies the classification like this. So they are showing the breakdown on the actual financial statement, on the face of the actual financial statement. We may not need to bore the users with these details. If the user himself or herself is interested in the details, then he can come back to the notes section. Then gross sales, this is how it is broken down. Okay, there's no breakdown, but we have excise duty, value added tax, cash collected from government. So you see some level of detail. That's the meaning of the notes. If you go to note 7, it's on cost of sales. So it shows you the breakdown of the cost of sale. Direct production costs, production overheads, direct depreciation expenses, other costs. Okay, so that is what the notes do, explaining the details that are normally hidden on the face of the financial statements. Okay, so revenue, then the basic ideology behind preparation of financial statements is that, in this case, income statements or statements of comprehensive income, is that if I have my revenue, that is the gross receipt from the things we have sold, to be 1,000, for example, then the costs on the items that I have sold, or the costs that was generated in selling these items for the 1,000, I need to aggregate all those costs. That is what we call cost of sale. The costs associated with the revenue you have generated. It may come in the form of how much you bought the goods that you have sold for 1,000, or how much you manufactured them, depending on whether you are a manufacturing concern or you just buy and sell. The cost of the labor, direct labor involved in the selling, and all other direct costs that makes the sale possible. We put all of them together and call them costs of sale. Cost of sale is also referred to as cost of goods sold. Cost of goods sold. So in other texts, you might see it as cost of goods sold. In other texts, it might be as simple as cost of sales. They mean the same thing. So if the cost of sales or cost of goods sold is, let's say, 500, then your profit is 500. This level of profit is referred to as the gross profit, because apart from the costs that you incur in selling the goods immediately, the immediate cost associated with selling of the goods, there are other costs as well that are quite remote from the products and its selling. For example, if you take the University of Cape Coast, for example, we are selling services. We're selling the services to you students. So the cost of me teaching you is a direct cost. The cost of me coming to maybe Sunyani to teach you is also a direct cost. All the direct costs involved in delivering the service, they constitute the cost of sale. The revenue in this scenario will be the monies, the gross monies we take from the students. That's the revenue. So when we take the direct costs from the revenue, then we get a gross profit. But you also know that the Vice Chancellor and his office, the General Administration in Cape Coast, they are support staff, they are support arrangements. They are not directly involved in the service, but they also generate costs. So we have to come back and deduct all those costs from this gross profit. Then the bottom line is arrived at. Then we can say we have ultimately a profit or we have a loss. Okay, so apart from this direct cost called cost of sale, we also have other costs. In most financial statements, they will caption it as operating expenses. Operating expenses. Then the operating expenses is normally categorized on functional basis. So maybe we have administrative expenses, selling, and distribution expenses. So all of those other costs are now deducted. When they are deducted, so let's say this is 200, this is also 200, and let's assume these are all the operating expenses. Then we will have, normally the presentation will be like 200 here, 200 here. Then we have a total for these two items to be 400. This is subtracted from this, and we have 100. So this becomes our net profit, or profit for the period. So this is basically how the income statement, to be precise, the statement of comprehensive income is prepared, and it is on the same basis that Guinness-Ghana's financial statement is prepared. So I just wanted to show you those kind of things so you can understand what you are seeing here. So you see, cost of sales is the immediate cost, and when you go to note 7, they will tell you the breakdown of the costs, which we subtract from our sales to get our gross profit. So you get a gross profit is here. Then we less all the other costs, normally referred to as operating costs. So we have advertising and marketing expenses, administrative expenses, other expenses, impairment charges on financial assets, other. Okay, so all of those things will subtract because the expenses subtract from the gross profits. Then we get our net income. Well, you see here they have put other income. They want to show a difference between revenue and other income. Revenue is the income that comes from your core operations, but there could be other incomes. For example, you sell a fixed asset, a non-current asset. You don't trade in fixed assets, but maybe the fixed asset has finished serving its life, and there is some scrap value. So you scrapped it for some few dollars, some few cedis. That needs to be recognized as income, but it's not part of your revenue. So they are yes, sir.
Please, it seems you are moving too fast.
Okay, so if I'll try to slow down, but in case anybody has any question along the line, please don't let me go far. You can intercept the lecture, ask the question for clarification before I proceed. Thank you very much. So the other income put here is, the way they have put it here is not too friendly for presentation purposes. They should have summarized all the other costs and provided the total, then possibly subtract it from the gross profit and get another level of profit before they add the other income. Or after just getting the gross profit here, you can add the other income to get your total, or your gross profit adjusted with the other income, and then you subtract the other expenses. However you do it, the bottom line is the same. That's the most important thing. So we have gross profits, then we subtract all the operating expenses, all the other expenses apart from the direct expenses, and then we get our net profit, assuming there is no other income. If there is any other income, we add it to get our total or bottom line net income. So you see this profit from operating activities.
Hello, sir.
Yes, sir.
Please, when you mentioned the cost of sales,
Yes, sir.
that they are costs that are directly involved in generating the revenue.
Yes, sir.
And then I was looking at the distribution costs that won't it form part of it, because some way, somehow, it contributes in generating also that revenue.
In fact, all the costs, not only the distribution costs, all of the costs ultimately contribute to generation of the income. Here the argument is proximity. Which of these costs is so close to the product as if it is even part of the product cost building? For example, if you're a manufacturing company, the cost of the the raw materials, the charge of the labor who is combining the raw materials into the finished goods, they are seen to be very, very proximal, very, very close to the product. So they build up the product cost. You understand? Some other costs may be generated, but they may not be too close to the product to form the product costing. So the cost of sale you see here is the cost that goes into the valuation of the product. So that when we say, okay, this is Guinness, so let's talk about just one product. Let's assume Guinness deals with one product, which is the Guinness beverage. So this cost of sale, it is the cost of producing and making one bottle of, or all the bottles of Guinness available for sale. All the costs. So all those costs are very, very close costs to the product itself. Then apart from that cost, so when you take one bottle of Guinness, the costs the price that they put on it, let's say it is 5 cedis. If you strip the profit element, let's say the profit loading on it is 1 cedi, then that 4 cedi constitutes the material cost, the cost of the bottle, the cost of the water, the cost of all the things that have gone into it, plus the labor that did the manufacturing in the factory, plus all the costs that are very close to the manufacture of the product. Those form the direct costs, or the cost of sale in this regard. But you remember, after making the product available for sale, there will be other costs like distribution costs, advertising. If you go to the radio station and you make advertisement on the products, you advertise in the newspapers and so on and so forth. Those costs are incurred with the aim of making the product sellable, but they acquire a mode from the product itself. So we do not add those costs to the cost of the product. We don't charge the product with those costs. So those costs are not product costs. Otherwise, nobody can even buy the product. So that's the meaning. That's the meaning of what I'm trying to say. So when you see advertisement costs here, advertisement and marketing expenses, this may be costs like radio advertisement, maybe promotional expenditure, buy one get one free, all of those kind of things. They are not direct costs. They are not like the cost of the material, the cost of the liquid, and all those things, and the cost of the labor who is combining them. So the difference between this operating expenses and these costs of sale is that this one forms the cost of the product, the charge for the product to carry. This one we cannot charge. We subtract it from the profits that we will get. Is it understood?
Yes, sir. Yes, sir.
Okay, thank you very much. So when we subtract all the operating expenses from our gross profit, then we get what is called operating profits. Operating profits. Here they have titled it profit from operating activities. It's the same as operating profit. Operating profit because at some point in time, government will come in and take some money from us, but government has done nothing. But we have to pay government as an expenditure, taxation. So we may want to know how well the company has performed by itself before other external events sets in. So this is up to this point, up to the profit from operating activities, is where we are trying to gauge how the company is doing in terms of profit from its own activities. There are no externalities yet. This profitability is based on the company's core operations. Other things that are ancillary, other things that are not really part of the core business have not been captured yet, because we want to see how well the company is doing from our core operations first. So that is the profit from operating activities. Then these are the things that we think are not really part of the core operations of the company. Finance income, finance costs, I'll explain them. Apart from, for example, Guinness Ghana selling Guinness, selling Star and all those things, Guinness Ghana can also buy shares in some other companies it thinks is doing well. They also do that. They do cross investment. Guinness Ghana can buy some securities in other companies and so on and so forth. When they do so, they get finance income in the form of interest. Guinness Ghana can buy Government of Ghana T-bills, Treasury bill, and that yields interest. The interest collectively is called finance income. That kind of business is not a core business of Guinness Ghana. Guinness Ghana is not set up to have as its core operations investing in treasury bills. So that's the meaning of what I said earlier. We want to separate the profitability from core operations from other operations that is not part of our core mandate. So this is where they do investment in other companies or in government treasury bills. The income or the interest they get, which is titled as finance income, it is put here. Then others might also be investing in guineas, for example. There are maybe banks which are financing the operations of guineas. There may be some individuals who have granted some heavy loans to guineas. Some other institutional investors in guineas. They will also demand interest. And the interest that Guinness Ghana needs to pay to those people that are investing in Guinness Ghana is what we call finance costs. So normally in some other financial statement you will see these two to be netted. They will be put together. You will subtract the finance cost from the income and then report the net. But this one they have broken it down. However they do the presentation, the explanation is as I have given. So we capture these things as not part of the core operations. So when we add the finance income and subtract the finance costs, then we get what we call profits before tax, because we are yet to bring the government in. So you see the level. This one is at where we are measuring the profitability from the company's core operations. Then the next level, we adjusted this profit from core operations with other operations that are not core. Some investments that are not really part of our operations. So we have finance income, finance costs. Then we get profits before tax. Profit before tax, then it means the government is ready to come in. Government comes in with income tax expense. National Fiscal Stabilization Levy. Normally you wouldn't see this. I think this was a special levy on the kind of business that Guinness does. So normally you will see income tax expense. Then after subtracting income tax expense from profit before tax, you get profit for the year or net profit. So the net profit for Guinness for 2019 is 18,046,000 Ghana cedis. And always remember the currency notation here. This is Ghana cedi in thousands. It can be in millions. So when you are using the figures, you always have to remember that the figures you are seeing on the face of the statements are in thousands. So this is 18,046,000. In other words, 18 million plus. That's the profit for 2019. This is the comparative profit for 2018. Then they are showing other comprehensive income items that are subsequent, blah blah blah. But basically this is where the statement ends. Profit for the year. Okay, so this is how a typical, these are other explanatory information. The income statement will end here. Profit for the year. This is how a typical statement of financial position of a company, of a manufacturing concern looks like. A bank's statement of comprehensive income also is presented with the same logic as I've explained, but the appearance could be a little different because to a bank, what is an income may not be as traditionally what is an income for a manufacturing business. Banks sell money. So when they give loans, the proceeds from the loans, the interest from the loans, interest that people have to be charging on the loan, that forms mainly their income. Other incomes are like maybe commitment fees, all those charges that they do, that forms their revenue. And their expenses may be like the general expenses we have talked about here. Their liabilities and their assets can also be a little bit different, but predominantly they may be the same as this one. So we have used just this example to understand how generally the statement of comprehensive income appears. Let's look at the statement of financial position. This is the statement that tries to list all the resources entrusted in the care of the company, and then also showing all the people who have claims against these resources. In other words, all the people who are financing these resources. And then we learned last week that the balance sheet or the financial position statements elements are assets, equity, liabilities. So that's how you are seeing them here. And the statement is prepared on the basis of the so-called accounting equation. Asset is equal to capital plus liabilities. And then we also learned about the categorizations in each of the elements. So when you find assets, you see here, it's listing the non-current asset first. So property, plant and equipment, intangible asset, giving us total and current assets. Then we have the listing of all the current assets. Then we total, then we have total current assets. The addition of the non-current assets and the current assets gives us total assets. For 2019, the value is 658,468,000, and we have the comparative figure for 2018. Then equity and liabilities, we have the equity to be this. Liabilities, we will show long-term liability or non-current liability, and then also show current liability, and then show the total of the two. When we add the total liability to equity, we get total equity and liabilities, and it should be the same as our total assets. So 658,468,000, same as the total assets. Yeah. Statement of changes in equity, blah blah blah. So these are also parts. There are other statements. Statement of changes in equity, statement of cash flows, and some other notes. But for the purposes of this class, we will be dealing mostly with the two first statements I talked about. The statement of comprehensive income, also called the income statement, and the statement of financial position, traditionally referred to as the balance sheet. Yeah. So we know how it appears. So now, and we understand all the elements, what they mean. Now, if you get hold of a financial statement like this one from Guinness, Ghana, you are a user. Let's say you are an investor, or take yourself as a potential investor into Guinness, who wants an advice from the statement on investing decision, whether you should invest in Guinness or not, credit decision, if you're a bank, whether you have to give loan to Guinness or not, and some other decisions. You may also be interested in, if you are a potential an existing investor, you may be interested in knowing from the financial statements the amounts of interest or dividends that you should expect, and the timing of them, when they should come, and so on and so forth. So you'll be much interested in many things. How do you get the information to know all these things? That's where the analysis comes in. So the analysis simply means employing some quantitative analysis on the financial statements to get further information or enhanced information to guide your investing, your credit, and other decision making. Any questions so far? Hello class, any questions? Hello, are you in class or you have left me?
We are here.
Okay. Any questions?
Yeah. Not yet, please.
Okay, so let's proceed. So now let's come to the analysis. We basically have we have a number of analysis tools. We'll talk about these ones for the purposes of this class. We'll talk about what they refer to as horizontal analysis. So we'll take the Guinness Ghana or maybe just any financial statement which will fit what we want to understand, like Ghana's income statement or financial statement. Then we will know what horizontal analysis is. We will apply it on a financial statement and see how it is done, and the kind of further information that it gives us to aid our decision making. We will also talk about what is referred to as vertical analysis. Okay, let me come. This is also called, the horizontal analysis is also referred to as comparative analysis. Comparative analysis. Then we will talk about vertical analysis, also sometimes referred to as common size financial statement or common size analysis. Then we will talk about 3, ratio analysis. So basically, we are going to talk about these 3 tools analysis tools.
Yes, sir.
Yes, sir.
Sir.
Yes, sir.
It seems people are trying to join the meeting, but they are not allowed.
Oh, they should be allowed. I have not put any restrictions on them, so they themselves.
Yeah, I don't know.
Immediately
They themselves should join the meeting straight.
Yes, straight. When you click on the link, it brings you to the meeting straight. I have not put any restrictions as to whether
add their institutional mail to their account. I think that's why.
Exactly. So please advise them to do the right thing. Once they do that, they will be able to join the meeting directly.
Yes.
All right. So let's take them in turn, and I want each one of you to be highly involved. They are not difficult at all. The reason why I'm stressing this is most especially for my friends in HR, marketing, management. They have the thinking that anything numbers is difficult. No, numbers are rather cheaper. So please bring your mind home here and psych yourself that this is very simple thing to understand, and I'm going to try my best to make it as simple as possible and as practical as possible. So you have to follow. If your mind is somewhere, then that's your own business. Okay, so let's take them one after the other. Horizontal analysis, also called comparative financial statements or comparative analysis. Basically what it means is that for the reporting entity to help the users of the financial statement to gain some information for their decision making, it has to, in addition to the reporting period, bring at least one other period, just like you saw about Ghana. Here, at least bring one other prior year, so that when, yes, the reporting period is 2019, but when I look at 2019, say property, plant and equipment of 418,655,000, I can directly compare it to the 2018 version of the same thing and see whether there is an increment or decrement. This is some form of analysis. This is what we call comparative analysis. And it is supported by the companies preparing what we call comparative financial statements. And it is simply bringing one or more prior periods in addition to the reporting period. Like in this case, at least bringing 2018 financials in addition to the 2019 financials. So we can just see the two and do some and inform ourselves of some basic ideas of what is happening. Oh, okay, it means they bought more property, plant and equipment in 2019. Intangible assets, maybe it got reduced. And note 13 is explaining why there was a decrease in the intangible assets. And note 13 will also explain the type of even the intangible assets. So if it was a goodwill which was classified as intangible asset, why it will also explain why it has reduced from 3116 to 2716, and so on and so forth. So that's comparative financial statements, comparative analysis, horizontal analysis. The horizontal simply means, see the way we are doing the analysis from here to here. So it's horizontal, as if you are drawing some horizontal lines. Okay. As if you are drawing some horizontal lines. So 2019, 2018. Then the figures, you check here against here. This against this. This against this. To inform yourself of something. This against this. And you are doing some horizontal line drawing, so to say. That's horizontal analysis. That's where it draws the name from. Now let's take a typical financial statement and see how we can also enhance the basic form of the horizontal analysis. In addition to just cross-checking 2019 figure with 2018 as the basic form of the horizontal analysis, we can bring in few other information to enhance the information for ourselves, for the decision making. At least we can bring another column. We have this column and this column. We can bring another column that captures the dollar change between the 2 years. What is the dollar change? Okay, that makes it readily available for decision making. So we can bring a column here and do the dollar or CD change. This will be CD change, but yeah, reported in CDs. So the CD change between the 2 years, and then we bring another more column to calculate the percentage change. That will be okay. That will give us enough information to guide our decision making. So let's see how we do that. For practical purposes, I'm going to do that level of analysis with spreadsheets. That also means that we have to remind ourselves of our basic spreadsheet skills. This doesn't require you to have some skyrocketing spreadsheet knowledge, the basic ones. And most of you are already in employment, and you know that in business the basic tool has been spreadsheets. Yes, whether you have the most sophisticated accounting software, you still will have to do certain things with spreadsheets, and most of you do. In case you are not abreast with things with spreadsheets, you can arrange that we have some parallel arrangements, so we bring you up to some speed on that. And you need those things for your job and for your own productivity. That's very important. So let's see this column. So there is this there is this statement for a company. This is, it may be a fictitious company, Ranger Wholesale Company. Comparative income statement for the year ended, we have 2019-2018, December 31st, 2019, December 31st, 2018, for 2 years, just like you saw with the Guinness statement. What we are trying to do is how you yourself do the analysis, because when you pick this statement, you will take your calculator. But in modern business, we don't do things with calculators and pens. That is why these tools are designed. So you have to learn how to do the things you traditionally do with your calculators. You have to now begin to do them with these things. If you still stick with the archaic way of doing things, I bet you will not be productive and nobody will need your services. So let's say we have imported the statement into spreadsheet. Either we typed it, it could be our own company's financial statement that we prepare, so we can have the spreadsheet version. So we have our gross sales is here. We have our sales returns. Sales returns is the sales that we are doing a sale, the ones that people return to us. We have to subtract it from the gross sales to get our net sales. I hope you can see the screen. Let me try to make it a little larger. Okay. So we have our net sales, then we take our cost of sales from it, we get our gross profit, we subtract our operating expenses, all our operating expenses, then we get our operating income or profit before interest and tax. Operating income or profit from operations is also referred to as profits before interest and tax. Please, you can be putting these terms down so that when you are reading, it doesn't confuse you. So we subtract all our operating expenses, and you see the categorization. They have categorized them into functions. So we have selling expenses, and the selling expenses, these are the categories: advertising, sales, salaries, stores, supplies, depreciation. So all of these things go under selling expenses. And I try to do the breakdown just for explanation purposes. In a typical financial statement or typical income statement like you saw of Guinness Ghana, all of these things will be compressed into one item, selling expenses. Then we have general and admin expenses. The breakdown is into these things. So all of them put together. So you see the total. So this is the total selling expenses. So in a typical financial reporting, you will see only this one being reported, and maybe this will be shown in the notes. All of these items forming this total will be shown in the notes. Same thing is happening to the general and admin expenses. This is the total figure. That will be the one that will be shown on the face of the financial statements, the reported financial statements, and this will be shown in the notes as the details. Then we have total operating expenses, which is the sum of all the things going into the operating expenses. So total operating expenses. Total operating expenses. It is 1,86700 for 2019, and then we can see the comparative periods figure. When we subtract this total operating expenses from our gross profit, this is our gross profit. Our gross profit is $245,000 for 2019. So when we subtract our operating expenses of 1,86700 from gross profit of 245,000, then we get operating income, also known as profit from operations, also known as profit before interest and tax, of 58,300 for 2019. Then this, like I explained, this is the one measuring how the company has performed in terms of profit from its core operations. Then we come to the things that we think are external issues or they don't form part of the core operations. So things that don't form part of the core operations is net interest expense. It means that they have already subtracted the expense from the income and they got the net to be an expense. Or the company doesn't receive any interest income, it only pays. Whatever it is, that's not the point. So less interest expense. This is the interest expense. When we do the netting or subtraction, we come and get what is called profit before tax. Profit before or operating income before tax of this. Then government comes to take the tax of this amount. Then we get profit for the period or net profit to be this. Alright, so this is the income statement for that company. We can do the comparative analysis by just checking, when I take gross sales, 2019 and 973,500. That was an increment. But by what? By how much? So that is the CD change. And then we are supposed to do the calculation for the CD change. This is how you do it. How do you calculate this basic mathematics? Someone to contribute to the class. I don't have to hijack the class. Yes, class. How do we compute the CD change between the two periods? We are doing it for gross sales. How do we compute the CD change If you want to talk, mention your name. I'll call you, and then you talk. Hello? Hello, class? Hello? Can you hear me? Hello? Hello, can you hear me? Can you hear me, please? Hello, class. Hello? 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 Hello?
Yes,
Hello?
sir.
Yeah, sorry, there was an interruption. Okay, so
Yeah.
let's get back to business.
Okay, sir.
Please get your microphones and your videos off. Daniel Cheneboa, turn off your video, please.
No.
Okay, hope you can see my screen now. Can you see my screen
Yes,
now?
sir.
Okay, so before
Yes, you can see it now.
okay, thank you. Before the link went off, we were explaining horizontal analysis, also known as comparative financial statement or comparative analysis. And then we had already explained that it basically means companies presenting their financial reports in such a way that apart from the reporting period, they bring at least a comparative period financials for us to be able to compare. For example, I can look at 2019 gross sales and just cross-check it immediately with 2018 and see that, oh, okay, there is some change. In this case, an incremental change. But We enhance this form of analysis by bringing two other columns I explained earlier. This column, which measures the CD change between the two periods, and then this one measuring the percentage change. So we were about to do the computation for the CD change and the percentage change. And it's a question to the whole class. How do we calculate the CD change between 2019 and 2018? If you have the answer, if you want to contribute, just mention your name and then I'll give you the chance to talk. Who wants to talk? Hello, class.
Hello, sir.
Yes, your name. Let me know your name.
I'm Rosemary.
Yeah, Rosemary. So Rosemary wants to help us with how we will calculate the CD change for the two periods.
In fact, you compare the figures, the assigned figures that they've given, and the difference between the two.
So speak in specific terms. The statement is right before you, so speak with reference to the statement.
For instance, when you take the gross sales, 973,500 in 2019, then
Yes.
853,000 in 2018. Then the difference between the two, you see that there was an increase.
Yes, we know that. So I'm only interested in how you do that simple calculation. It is simply this one minus this one.
Deduct the 2018 one from the 2019 one.
Thank you very much. Thank you very much. So in your textbook, the traditional way, you will just do. Oh, I don't think I even need to bring this. Let me just. You will just do. Let me just write here. You will just do for here, for example, 973,500 minus 853,000 is equal to, then you put a difference there. And then you do same for almost all the items. But in spreadsheet, because that's what we're going to do, we want to do things that reflect what we do in life, in business. Because we cannot learn something different from how we do things in the business world. That's my thinking. So this is what we are going to do. Here in spreadsheet, to make the spreadsheet understand that what you are doing is a formula, you precede whatever you are going to type with an equal sign. That's the way to tell the program that I'm doing a formula. Because this is a formula work, this minus this. So you do equal to, then you point on this cell, the cell that contains the 973. Then you press on your computer the key that has the minus. Then you press on this one. Yeah. That's all you do. We press enter to complete the formula. So the difference is 120,500. Then when you are done, you now can drag. When you click on the formula you have created for here, you now can click down to complete the rest. You do not have to compute for each one of them. And that's one of the beauty of using spreadsheets. So when you hover your mouse, you see this small box here. There's some small box here. At the the right down corner. When you hover your mouse on that thing, it will turn into this black cross. You click and hold and drag it down here. Alright, it will finish everything. It will now do for each here, it will do this minus this. This is the figure. This minus this is the figure. Alright. If I don't want the CD symbol to be repeating, maybe I can copy the formatting here. When I come here, I'm copying only the formatting. And then apply the formatting on this one. Okay. copy the formatting here and apply it also on this one. Okay, just to make it consistent with the design. Okay, so that's how you do the computation. This minus this minus this gives you the CD change. Then the percentage change. Percentage change, the formula for calculating percentage change is, formula for calculating percentage change is the new value, which is the change, new minus old, which is the one we have already computed, divided by old times 100%. This is the full formula. So we have already done the top here, which is the change. So in other words, it is change divided by old times 100%. This is the formula for calculating percentage change. So we can do that here. So here to be equal to this change divided by, so on your keyboard you press division sign. The division sign will be as you are seeing, the forward slash key. That same key has the question mark on top of it. So the change divided by the old figure, which is 2018. So I click here, 20 divided 2018. Then you press enter. So this is the percentage change. It puts it in fraction first. You can click on it and go to your home tab and click on this percent symbol to convert it to percentage. So approximately 14% change. When you drag down, it will complete the rest for you in terms of percentage changes. So between 2019-2018, our gross sales increased by 14%. Yes, sir.
Can you go over this one?
The percentage change.
Yes.
Okay. The way we calculate percentage change is this. Let me write it boldly here. You are calculating the percentage change between two things. So let's say 2019, 2018. How things have changed from 2018 to 2019. The formula is 2019 minus 2018 divided by 2018 times 100%. That's the full formula. But from what we did earlier, calculating the CD change, we had already calculated this when we did 2019 minus 2018. That's what Rosemond helped us to do. So we have this one already calculated in the columns. We have it calculated here. So 2019 minus 2018 for gross sales is 12500. So we only need to do the remaining formula, which is dividing that change by the 2018 figure and then converting it to percentage. Please, are you okay? Are you okay with the underlying formula?
Yes.
Okay. So how we did it in spreadsheet was this. We have already said that in spreadsheet, anything you are doing that is a formula, you tell the program it is a formula you are doing by beginning with an equal sign. So I did is equal to the change, so this one, divided by the 2018 figure. So I came to click on the 2018 figure. Enter. You can put this in bracket and multiply it by 100. But there is already a button that converts it to the percentage. So that's why I didn't do it. So I pressed enter. Okay. And it initially converted it. Let me show you. It will initially show it as a fraction. All right. As a fraction. Then you want to see it in, this is the same as percentage. If you want to see it in the normal percentage form, you just come and you click on this cell that contains this value, and then you come and click on this button. This is the percent button. So when you click on it, it will convert this figure to percentage, 14%. Then in Excel, let me explain a few things. The Excel uses what we call, by default, it uses what we call relative cell referencing. So once I do this, which is this divided by this, it will understand that when I come to this cell, I will want to do this one also divided by this. So when I drag, it will do all those things for me automatically. That is what we call relative cell referencing. So when I move one cell down, it will also move all the cells that were involved in the formula building one cell down. So when I move, I drag one down like this, it will come and pick this and this. When I move it another down, it will come and pick this and this. That is relative cell referencing. Alright, so I drag to 4. Okay, and then you see all the percentage changes. So the only thing we are adding to what the company provides this, is to add this CD change and the percentage change to give us some information which is so ready for decision making. Are you okay now, senior?
Yes, please.
Okay. So the main thing is that in such an analysis, you look at the items. These are the items on the financial statement. The items with huge, maybe CD change. Of course, if you have the percentage is very ready to assist you with which one has really swinged very much. So huge percentage changes will kind of highlight things for you. Then you go and see, okay, which item is that, and what is possibly explaining this huge change. So that is the information driving you to take a decision. So here we see 32%. What item is that? Sales returns. Wow. Okay. Sales returns is the sales that we have made to people, the things that people have come to buy from us. The amount of them that they return, that's what we call the sales returns. And it has increased from 2018 to 2019 by 32%. Is it a good thing or a bad thing? A good thing or a bad thing?
Good.
Your name, please.
It's a quick.
Explain why you think it is good.
Yes, these are the items that we put on the market for income and demand. And so if they bought and then paid for it, it means we made a good sale. So that's what I say is good.
I don't understand your explanation. Take your time, and you are explaining to all of us. We want to understand you. So take your time, break things down.
Yeah, so based on what you said, the sales returns is what people have come to buy from us, the money that we've received.
No, that's not what I said. Who can explain to him what I said about sales returns? Your name, please. Bafo. Please, you can speak a little louder. Then let him understand what I said sales returns is.
You said the goods that the people bought from us and they have returned it back to us.
Exactly. Senior, have you now understood what sales returns is?
Yes, please. Then my answer is wrong.
Okay, so now come again.
It's not good. It's bad.
It's bad. So how is it bad?
Yes, it means that either our product is not good, hence they return it to us, and that also affects.
Thank you very much. So either our products lack the quality, or maybe our ordering, shipping systems or dispatching system is bad. So when customers bring order that I need color red, color blue, people are so lazy or they don't do things right, they go and ship different color, or they go and ship different item. When it is like that, they will bring them. Okay, so it is bad. And look at it. What makes it even more worse is the rate of the increment. This thing is something that should be managed to go down. It is rather rising by 32%. So this is the kind of thing that the comparative statement, as we are learning now, will help you to highlight and direct you to take decisions on them. So at least you know that, okay, this one I have to make red. Then you have to go and investigate what is causing this thing to happen. Okay. Gross sales growing by 14% is a positive thing. We may even want it to grow a bigger percentage. This one is gross profit, just growing by 11%. The key thing here may be the 32% increment in sales returns, which is a bad thing. We do the same thing for the rest of the items. So I know you can complete the rest. When we come here, we'll just do for the CD change is equal to 2019 figure minus 2018 figure is equal to, so this is the change. And then the percentage change is equal to this change divided by the 2018 figure converted to 100. So let me click my percent sign, which is 50%. Then once I've built for this, I can drag down like this, drag this one also down like this. All right. I can maybe click on this, copy the format, and then apply it to all of these. So one CD sign goes for the way it is indented, it goes for all of them. It depends on your style, your choice of style. The most important thing is the figure. So this is the change in these items, the advertisement items, between the 2 years. Advertising expense has changed by 2,500. It actually increased by 2,500. This one is increasing by 12,000. All of them are increasing. And this is the percentage increment. 50%. The 50% is high, so you may want to be interested in it. Advertising expenses. What is actually going into that? What is informing the fact that advertisement has increased by 50% from 2018 to 2019? What did we do? The increment, does it have a merit? Where we write, is it feeding into sales? Possibly. So you may want to link this advertisement expenses to your sales growth. We have increased our advertisement expenditure by 50%, and between the 2 years of the 50% increment, sales is growing by 14%. I mean, let's talk about net sales. Net sales is growing by 14%. So maybe you can say it's good, but some people may want to see, okay, at least, well, that's okay. 50% increase in the expenditure, generating 14% increment in sales revenue. So the overall thing is to check whether the increment makes sense. And whether it will make sense or not will depend on the impact that it is bringing. This one can be maybe 1,000%. But if it is feeding into a reasonable increase in our net sales, that may be okay. Okay, are you okay?
Hello, sir.
Yes, sir.
Yes, we are okay.
Yeah, this teacher.
Okay, Peter.
Yeah, looking at the 50% increment in advertisements.
Okay.
And if there is an increase in gross sales of let's say 10%, do you say it is good?
Peter, I think I must ask you that question. Okay, it's for all of us. There is an increment in advertisement expenditure by 50%. The percentage shouldn't be used in isolation. The 50% increment is in the form of, in terms of CDs, 2,500. So we increase our advertisement from 5,000 to 7,500. So there is an additional advertising expenditure of 2,500 Ghana cedis. And it is generating sales revenue of
10%.
Yes, the 10%, but let's also look at the corresponding CD values. The increment of the advertisement was 2,500. It was increased by 2,500 Ghana cedis, generating an increment of 117,200 Ghana cedis of net sales. So would you say it's a good thing or a bad thing? Or is the advertisement yielding some positive results, or it is not doing anything? Yeah, Peter.
Hello, sir.
I'm talking to the one who asked the question. I'm trying to answer the question by answer.
Yes, sir, I'm here.
Okay, so this 50%.
Yes.
Okay, you see, when you say a percentage,
Mm-hmm.
let's say we have one person in class, right?
Yes, sir.
And then another person joins. There has been an increment of 100%.
Yes, please.
So if you hide the actual figures that explains the percentage, let's say we hide the student's number, and then we are only reporting with a percentage. Oh, the student, the class size increased by 100%. That alone might convey some big increments, you understand?
Yes, please.
But when you go and see the underlying figures based on which the percentages are computed, you only see that there is only one student who joined, because there was only one student who was there. Yeah, so we have to be using the percentages in conjunction with the CD changes. 50%, fine. The 50% is 2,500. We incurred an extra expenditure cost of 2,500. And this 2,500 is explaining, or approximately explaining, an increase in net sales of 117,200 Ghana cedis. So you have spent 2,500 on adverts, and it is bringing an increment in sales of 117,200. Then that may be okay.
I've got it.
You've gotten it?
Yes, I've got it. Yes, we can continue. Thank you.
Yeah, thank you very much. So that's how we do it for the rest of the statement. So you can complete this on your Google Classroom platform. This information is already there. You will see financial, you see income statement for, I think, Guinea's Ghana. Let me see if it is there. Guinea's Ghana financial statements. Guinea's Ghana. Yeah, it is there. You'll see that's GH-GGBL. GGBL is Guinea's Ghana Breweries Limited. The one I have attached there is the same figures, but is the unaudited. That one doesn't have the auditor signature on it, but it's the same statement. So you can download it. No, not this one, sorry. What we are using to work is not the Guinness Ghana statement. It is a different one, and that statement is also there. When you go to, I think, a little bit on top, you will see financial statement analysis. I have attached this Excel sheet, so you can download. You see it as a spreadsheet. You see Excel there. You can download it and experiment with it. You can download and just change it, do it, work with it, just learn with it to understand what we are trying to do. So basically, this is horizontal analysis. You can do the same thing to the balance sheet. So the balance sheet, horizontal analysis, this minus this, the percentage, then it's this. So if you take this, this one, it is 2019 is equal to 2019 minus 2018. That's the change. The change was a decrement. And then the percentage change is the same way. So it's equal to the change divided by the old 2018. Right, so if I want to see it in percentage, so I go and click on this percent sign. Right. So that is it. And then you can do the dragging as I've showed you. If we are using a traditional approach, it means you will have to calculate for each line item, punching your calculator, writing plenty. In exam, I don't anticipate that there will be a question. Even if there's a question like this, very simple. This is where you can earn most of your marks. I don't envisage there will be a question on horizontal analysis. But we are not learning for exam. We are learning for our own productivity at a job place. That is why it is accounting and finance for managers. And you guys are already in some level of managerial position. So you need it for your skill, for your productivity, not only for the grades, right? Good. So you complete the rest. Now let's go to what is referred to as vertical analysis. We are finished with horizontal analysis. Vertical analysis. Vertical analysis is also referred to as common size financial statement or common size analysis. All right, so let me try to do it here. That one too, we may have, you need not to have 2-year statement. It can be only one, because that one, it looks at only one at a time, vertical like this. It doesn't really care about horizontal. We are finished with the horizontal analysis, but we are using companies' financial statement. Normally is how they prepare them. So we have the comparative period. So after you finish with your vertical analysis, you can even do some cross horizontal analysis, but the concentration is on vertical analysis. This is what it means. All these items, let's say office equipment. Let me zoom in a little. Office equipment, store equipment, buildings, land, whatever. All of these things, we have to see the percentage of them as some value. This is what I mean. We may want to see the percentage of office equipment, or we may want to see office equipment, express office equipment as a percentage of our total assets, because it is part of total assets. In other words, this is what we want to do. Our total assets of this figure, total assets of 430,000. What percentage of the total assets comes from office equipment? What percentage or what fraction of these total assets is made up of stores equipment, made up of building, and so on and so forth? That's what we are trying to do. So we are actually going to compare all of these items to our total assets, how they compare with our total assets. So you see that it is very columnar. The same column, we take this one, compare it to this. We take this one, compare it to this. We take this one, compare it to this. So we are not doing any cross analysis here. That's how come it is called vertical analysis. And the essence of it is that it is good for you to know, okay, the office equipment we have, it is this fraction out of our total assets. It's some piece of information that can guide your decision. The whole of the total non-current assets, it is this fraction of our total assets. In other words, you maybe want to know how the constituents, how the total assets splits between non-current assets and current assets. What percentage of the total asset comes from non-current and what percentage comes from current? All of these information can be gotten from the vertical analysis. So in addition to the columns that the financial statements themselves present, we will also introduce this 2 additional columns. So the common size statement for 2019 and common size statement for 2018, for example. So let's see how it is done. Let me try to delete it. Okay, so let me redo it. So we do, this is equal to this figure, the gross sales, for example. We are doing it, okay. In fact, I was explaining it using the the balance sheet. Let me go back to the balance sheet. Yeah, sorry. Okay, so we come here. This is equal to this 2019 office equipment figure as a fraction of our total assets. So divided by total assets. And this is equal to 0.01. 0.01. You can express it as a percentage. 1%. So office equipment is just 1% of the total assets. When you come here, you can drag anyway. Okay, then let me explain this. You see this arrow symbol? It's because I earlier explained to you the concept of relative cell referencing. Do you remember how the program works, how Excel works on relative cell referencing? Not all formulas you are building will work with relative cell referencing. For example, in this formula, let's click inside the formula bar. These are the values it is picking. This one divided by this one. When I finish that formula and I want to drag, when I drag one cell down, it will come and pick this and then goes down below this and pick this. But we don't want this one to change. We don't want the total asset to change. The total assets always stay the same. Then these ones should change. In that case, you have to make this cell reference for the total asset be absolute cell reference, not relative. So in the formula, I should have made the B22, which is for the total assets, an absolute cell reference. And you do that by just adding a dollar before the row letter and dollar before the column letter and dollar before the row number, like this. Alright, and the quick way to do that, if you are using a standard English keyboard, is to click inside here, or immediately you click on that cell, press on the F4 key. Pressing on the F4 key will automatically convert that cell reference from relative to absolute. Are you okay with that? Okay, so now that we have done the formula right by making the cell reference to the total asset an absolute one, when we drag, it will understand that this one shouldn't change. So we can now drag down. Okay. So it is saying that office equipment is 1% of our total assets in 2019. Stores equipment is 4%. Building is 41% of our total assets. Now let's see. Buildings 176,800. 176,800 compared to 43, so it's 41% of it. This one is 0% because there is no figure here. So that's how it is. That's how it is calculated. When you come here, we can do similar thing. We can extend the formula. Let me drag the formula down, sorry. Okay. Total non-current assets. Total non-current assets is 58, approximately 58%. Approximately 58% of our total assets. I can extend the formula down here. It will complete the rest. Only that it will bring these ones here, then I can clear them. Right? So if you come here, merchandise inventory, or simply inventory. Inventory is 21% of our total assets. So if you have some inventory policy, and then you see that this percentage, this is the amount of goods that is left unsold at the balance sheet date, 21% of your total asset. That is a huge figure. So it is signaling that probably you are hoarding, or sales is not moving, or maybe that particular line of business is a slow moving business. That should tell you something for you to decide on something. Yeah. Short-term investment is 1%, blah blah. So basically that's what it means. This is vertical analysis, expressing all the items. In this particular case, the balance sheet items, expressing all of them as a percentage of the total assets. As a percentage of the total assets. So we can even go down. Share capital as a percentage of total asset. It is 58 point. When I do, this one, I physically type the formula. I didn't use this one to convert. When I click on the percent sign to convert to percentage, it will take this 58.14 to approximately 58%. So you can drag down. We can drag down this to cover the rest of them and delete the missing. Okay, for example, I have to delete this and delete this one. These are not applicable. These are also not applicable. So when you come, you see share capital is 58%, which is approximately 58%. We have rounded things down. So that's how we do it. Vertical analysis. How all the financial statement items compare with some base figure. And for the balance sheet, the appropriate base figure has been the total assets. So how all the other items compare with the total assets, including how even the total asset itself compares with itself. So it compares with itself 100% because it will be 1 as the total fraction. And how the rest compared to this base figure is as we have reported. So you can, like I told you, I've showed you where you can download this spreadsheet file. You can experiment by calculating for the 2018. And when you are done calculating for 2018, you can now check between 2018 and 2019. That will be some horizontal analysis. But strictly speaking, this is how vertical analysis is done. Any questions?
Hello, sir. I would
Yes,
want
sir.
you to please go over the first formula again.
The
one
first
you did.
formula.
You
This
get
one.
the absolute ones, yes. The one with the dollar sign.
This one.
Yes, please.
No, we have not computed anything. Or you are talking about the horizontal analysis?
No, the
we
vertical.
have finished with vertical horizontal analysis, so we are doing vertical analysis.
I know. I'm just talking about the formula. Just the formula. The equal to B7 slash the dollar sign. How?
The absolute cell reference. Thank you very much. Yes. Let me maybe explain it with some simple experiment here. Let's say you have some people who sell for you. So let's say they are here. The people who sell, these are their names. January, February, March. Let's assume they are names of people. And then this is the sales they have made. Let's say 100, 200. It's a fictitious example, but let's try to use it to understand. Then you pay bonus to them based on how they have done on their sales. So you will have, let's say, bonus. Okay, so this is name of the person. This is gross or sales that the person has made. and then he's paid bonus on his sales. All right. So the bonus calculation is some percentage of the sales. You can do this. Let's say bonus percentage. Everybody is paid 5% on his sales. So 5%, 5%, 5%, 5%. Because it is the same, it doesn't change across them. Sorry. Doing 5%, 5%, it's quite redundant. It's even not appealing. It's quite redundant. Why type the same thing? So if you are dealing with, let's say, the whole of Ghana's population, so you type 5, the amount of Ghana's population. That doesn't make sense. It's quite redundant. So you may want to change your design from this into something like this. Okay, let me just hold. So in this design, you will do bonus percentage here before you come and do bonus, and then your calculation will be is equal to sorry, this is 5%. So let me make it percent. No. So 5%. So I'm going to do is equal to these sales you have done times your bonus percentage. That tells me the bonus. I should pay you a bonus of 5. Then when I drag down, then I can do for the rest of the people. Okay. So this design, what I'm saying is wrong with this is the repetition of this same 5 is quite redundant. We don't do it like that. It's not even snappy. So you can change your design from this by doing this. I can put, this is a key input variable, so I can put it somewhere here, and then remove the whole of this, and then bring the bonus here, right? I don't even need this column again. Then when I'm calculating the bonus, I'll reference, since the percentage is the same for all of them, I'll put a percentage here, 5%, and then reference this same cell for all of them instead of repeating the 5% across all of them. And when I'm doing this, it means that the first one I did, when you drag the formula, let me go back. When you drag the formula, okay, look at the first formula by clicking the formula bar. It is telling you it is this cell, which is H5 times I5. Alright, when I move, it is this same formula that I dragged. When I drag, the program understands that when I drag one cell down, I also want to drag the formulas that the formula the cell that the formula is based on also one cell down. So if I drag one cell down, like this, then this should also be dragged one cell down. That's what we call the relative cell referencing. But if you do your design in this way where you repeat percent, then relative cell referencing is fitting. But we are saying that this design, accounting wise and even data management wise, is quite useless because you are typing the same thing so many times, which doesn't make sense. So make the presentation snappy. Let the 5% be here. Type it only once. Don't type it as many times as you have to compute the bonuses. Type it only once. When I type it only once, I can do the formula the same way as I did. Is equal to this times this. Fine. So you do the first one. If you drag Okay, it's here is formatted as percent. Don't worry. So let me move it to general. So this is the first formula we did. This times this. When we drag, because the program is by default on relative cell referencing, when I drag this here, I'm coming. When I drag the formula one cell down to here, it will move because we used this and this. So when I drag down, it will move this one cell down and move this one also one cell down. But when you move this cell one cell down, there's nothing here. So the formula becomes wrong. You always want this one to stay the same, but this one should be moving to pick the figures here. In that case, you have to change the cell reference from relative to absolute. So when you are clicking here, you click here and then you press on the F4 key if you're using the traditional English keyboard. Or if it doesn't work straightforward as that, you can just add dollar symbols before the column, letter, and the row number. Okay, so that is it. So let's move on. So what I do is that when I am doing this formula, let me click in the formula bar. I will, before even doing the formula, let me delete everything. I'll do it this way. Is equal to this. Here I don't need any dollar sign because here it has to move. Then times, when I click on this, I'll also press F4 key to convert it to absolute cell reference. In other words, I have locked that cell at where it is. When I drag the formula, it shouldn't move. That's what it means. So now when I drag, it will understand that it should apply the same 5% for all the figures. Right? This is snappy. And when you do it like this, you can always even change this one. I can change this to, okay, what if I increase their bonus to 10%? What happens to them? Then you can see that it reflects automatically. Please, are you okay?
Yes, sir, I'm okay. I'm okay.
So, thank you. So that is also about the vertical analysis, also known as the common size financial statement or common size analysis. So we have done horizontal analysis, we have done vertical analysis, and we have done them using spreadsheet because we want what we are learning to be reflective of what we do in real life. I don't see the importance of learning it different in classroom. So when are we going to get a time to relearn again? So that's why we are doing like this. When you go home, you have to practice. Now let's go to the next analysis 2, ratio analysis. What's the time now, please?
Please, I have a question.
You have a question, please ask.
Yes, please. Sir, good afternoon. My question is about exams. You have this horizontal, vertical, or SPH for us to do. It's going to be normal way of solving exam questions. Meaning you are not going to use it spreadsheet. Sorry.
Please, can you come? Your link is not quite clear. Can you come again?
Okay, sir. Please, I said in exams, I'm asking with reference to exams. Are we going to have a spreadsheet like this to do the horizontal and the vertical analysis, or we just learning this one to be part of our day-to-day activities? Thank you.
For exam purposes, if this should be asked in exams, you will not be using spreadsheet. But the question is not spreadsheet or spreadsheet. If this question comes in exam, you know the understanding. For example, common size financial statement, this item divided by the total assets. You put a figure here. This item divided by the total assets. So whether in the exam you will be asked to use spreadsheet to do it, or you should do it the traditional way by using your calculator, that doesn't pose any challenge, or it poses some challenge for you? Let me know.
No, sir, please. I just want to know. That's all.
Yeah, normally, the challenge we have. Our activities are not aligned with technology, and that is quite a problem in our country. But the importance I want to stress is that I don't want us to take the course we are reading now as the traditional things we've been doing from primary to undergraduate. We are learning with no practicality in mind. Right now, all of us, to some extent, are employed. Some of you are even managers. Some of you are big people in your workplaces. The essence of you taking this further education is not to just acquire A4 sheets. No, we should just take those things out of the equation at all. Accounting and finance for managers is to enhance your productivity at the job place. So it has to be based on practice. So I don't see the sense in teaching with marker on the board, and then you don't see how this thing you are learning connects with the things you are doing. Sometimes you hear people say, but these things we are doing, that's not what we do. It's because we don't do it the way it is done in the field. Otherwise, people will realize the connection. There's always a connection between what we do in classroom and what we do in the field. So I want us to get the understanding. The understanding is very basic. This divided by this minus this. Very basic mathematics. If you take your calculator and your pen right now, you can do this layout and compute these same things that the computer is generating for us. But for practice purposes, you just need to know how this thing is done with spreadsheets. So that it's like we have two birds killed in one. And you have an advantage. Those who will be teaching them on board traditionally, press calculator, press this minus this, then you write the figure there. They'll be having some disadvantage. You may be having an advantage over them because you know how to do that one. Plus, knowing how to use a spreadsheet to do something at least. Okay. So thank you for your question. So let's look at ratio analysis. I wanted to know of the time. How many hours have we spent? We started, let's say, officially 10:30.
It's 12:35 now.
Hello?
12:35 as now.
12:35. So how many hours have we used so far?
2 hours.
2 hours.
2 hours. Yes.
Okay, 2 hours. If you wouldn't mind, I'll just give some, or I should just continue for us to finish. Let me continue. Let's finish, then all of us are free. Okay, now let's come to, let me talk about trend analysis first before we come to ratio analysis. Trend analysis. Trend analysis it has some element of comparative analysis. Only that trend analysis involves so many years. So you want to see what is happening across many years. So you see, trend analysis will typically involve like 5 years or more than 2 years, let's say so. From 2 years, maybe 10 years. Mostly, some companies do 5 years. And this is what we do basically in trend analysis. Very simple. If you take this simple example, we have sales, cost of sales, gross profit. It can be for the whole of the financial statement, but I'm just taking an extract from it, because it will be the same thing. In trend analysis, we are only trying to compute index numbers. So we have some base year that we want to compare the change across the other years from that base year. So if our base year is, say, 2014, how sales, for example, how sales has changed from 2014 to 2015, 2016, 2017, 2018, 2019. So what is going to happen is that we are going to lock everything. So at 2014 is the reference period. So the figure in 2019, how far has it changed from 2014? The figure in 2018, how much has it changed from 2014? The figure in 2017, how much has it changed from 2014? So the 2014 is the reference year. Also, it has some element of vertical analysis where we compare every other item to a base item in the balance sheet, for example, comparing every balance sheet item to the total assets. So there is that similarity with the common size financial statement. We are comparing everything else to the 2014 figure across different years. So the across the different years also takes something from the horizontal analysis, so that we can say that, oh, this is how far sales has grown from 2014. So 2014 was like some stable period or whatever it is that is informing us, using it as the base period. This is how far we have come since 2014, for example. That's the idea behind trend analysis. So if you look at the down part, what we do is just to compute what we call trend percentages. Trend percentages. It helps because when you see percentages readily speak. That's why we are doing that computation. Of course, you can see the same increment from 2014 to 2019. 2014 was 210,000. 2019 is 324,000. You can get a sense that yes, there is an increment since 2014. But it will be more comprehensive if we capture it in percentage. For example, sales has grown by 154% since 2014. Since 2014. That is ready for understanding. That is more understandable, more logical than just using the absolute figure. That's why we compute the trend percentages. And this is how we just compute them. The base period is the period you lock. So let me write it here. The formula is, this is the base period. The base is always at the base. So the base period is here. Then all the other years. So for example, if it is 2019, so 2019 will be here. 2019 figure divided by the base period times 100. And then in Excel, we will not do the times 100 because we can just click some button to do the conversions for us. That's the formula. So when I take here, so let's redo all these things I've done. You can do for 2014 itself. That will be is equal to 2014 divided by 2014 again. And it is 100%. In terms of fraction, it will be 1. Then I come here. Is equal to 2015 divided by the base period 2014 times 100. The cell is already formatted as percentage, so it will automatically show it percentage. It's 97%. Then Excel can be intelligent. See this formula. Let me click in the formula bar. It understands that this one is this 2015 divided by 2014. So when I drag here, it will move all the cells. Also, it will move them by one cell to the left when I drag to the left. Yes, it has that understanding. So I can drag like this. Can drag. Yes, that's what it will do. And if you want to check whether it's doing things right, come and click here. And click in the formula bar and see the figures it picked. It did 20. No, this is wrong. You see how it is wrong? Okay, that is quite wrong. So now let's get back. Here, this is our formula. This one is correct. 2015 divided by 2014. Who can tell me what is wrong with the formula? I want to understand if you are understanding all the things I'm teaching you. What is wrong with the formula we are building? If you are correct, I'll give you 5 marks. 5 marks free.
Hello, sir.
Your name, please.
This Peter.
Peter, yes, Peter,
Yeah, I
talk.
think yes. I think we need to make the 2014 absolute.
Thank you. That's it. So, Peter.
Yes, sir.
Let me take. What's your number? Oh, Peter. In the meantime, remind me. Let's proceed with the lecture.
Okay.
Just that you have to remind me later to give you that 5 marks, right?
Thank you,
Okay.
sir.
So we have to make the G4, which is the 2014 cell, an absolute cell reference, so that when we drag, the rest can change, but that one shouldn't change. In that case, I can drag again, and you see that they will be right. Yes. And now come back and check. You click here, click inside the formula. You will see that it picked 2016 and 2014. Go back to 2017. It will have to pick 2017 and 2014. Click inside the formula bar. It picked 2017 and 2014. So the way you do the formula is very, very important. So we have calculated the trend percentages. And then we will see that, okay, from 2014 across 2015 to 2019, the trend, the sales trend has been an increment. It is on the increased trend. 90, apart from just dropping in 2015, it is showing an upward trend. 195, 139, 135, well, 148, 154. So on the average, the trend will be upward. And you can do this. You can graph it. So let's try to do a chart for it. So we select only this. We want to see the trend in sales. Then I come to insert. Insert means I want to insert some Excel object, which is this is what do we call it? Chart element. So let's go to, let me do a line chart. So let me do just a simple line chart. Okay. So a simple line chart shows this. Maybe this was better. No. Simple line chart. Let me move it to its own sheet. So chart sheet. So we can see it bigger. So this is the trend. You see, generally it is an upward trend. In case you want to even insert a trend line, a straight line for you to see what the trend actually is, you can click on this trend line. So you see the trend line. Can you see that straight line? It shows an upward slope. You can generally see it to be upward sloping. So this is the trend in sales. And you can also see this. So in addition to the computations we are doing, the trend analysis will be complete when you can also add these charts. And these are things that you have to know for your job. So let's get back. Trend analysis. So this is what it shows. The percentages show generally an upward trend, and then it is confirmed by the chart. Yeah. We do the same thing for the cost of sales and the gross profit as well. The logic is the same. The base year is 2014. So if I'm here, I'll do 2014 divided by 2014, but you have to lock the base year. And then you can drag. You can do this one, 2015 divided by 2014. And then you log the 2014 period. You do it just like we did for the sales. You do the same thing for the gross profit. So you will come up with these same figures. You can chart all of these things together. It's as simple as selecting them, clicking insert, and just doing some line graph. You can do a bar graph, whatever it is. So this is how they are showing. They are just close to themselves. Let me move it to a chart sheet, different chart sheet. So it can be a little bigger. So this is how they are showing. So sales is the blue. Let me see if I can enlarge it. Sales is the blue. Cost of sales is the orange, and then the hash is the gross profit. So you can see cost of sales is lying on top of the sales after some years. Okay, at the beginning, gross profit was lying on top. When you see all these regions, gross profit is lying on top, so you see that there's much profitability. Gross profit is lying on top because revenue is lying on top of cost of sales. Revenue is bigger than cost of sales. As things progress, just around here, I think this is where the breaking was. Then cost of sales began to rise above sales. So you see that from here all coming is loss. So the graph is quite revealing about all of these kind of things that you may miss when you are dealing with the raw data. Okay, so this is quite not a profitable company. The company is going down in profit, and you can see it from here. Profit 100%. They maintain the same profits here. Quite some increment in 2016. That is what you saw in the graph. At the initial stages, there was some increment, but beyond this 135, it dropped to 132. Okay, let me see the graph again. Yeah, so that is what the graph is revealing. Quite the same as what the figures are also speaking. When you take cost of sales is generally on the rise, and the rate of increase in the cost of sales is going above that for the gross profits. That is why there is the loss. So you see cost of sales is rising. Let's take 2019 for example. It's rising by 158, while gross profit is 148. So when you match these two, you see that it will show like cost of sale is bigger, gross profit is lower. That's why you are seeing the graph in that way. Okay, so that's it. Any questions, please? Any questions? It can be on any of the things we have done so far, not necessarily on the trend. Questions, class?
Hello, sir.
Yes, sir.
So this is Peter.
Yeah, Peter, let me listen to you.
On the vertical analysis.
On the vertical analysis.
Yes, please.
Okay, let me hear you, Peter.
Yeah, you are talking about under that particular analysis, you have to compare every other item.
Can you come again, please?
Yeah, I said, if I heard you right, you are saying in that particular analysis, you have to compare every other item.
Okay.
Yes, and I wanted to find out if you compare
No,
the
your
item.
statement is not complete. Oh.
Come
Your
again.
statement is not complete.
I said in the vertical analysis,
Yes.
if I heard you right, you were saying you have to compare every other item when you're using the vertical analysis.
No, you didn't hear me right. I said you compare every item to a base item. That's why I said your statement was not complete, because the statement is hanging.
And that's what I wanted to find out.
Yes, you compare every. So let's go back. Vertical analysis. So this is statement of financial position.
Yeah.
The appropriate base item has been the total assets. So we want to compare how every other item in the balance sheet compares with the total assets. The fraction of every other item, or every other item expressed as a fraction of the total assets, expressed as a percentage of the total assets. So when I take, for example, merchandise inventory, this item is what fraction of the total assets? is what percent of the total assets? It is 21% of the total assets. In other words, when I do 21% times 430,000, it should give me 90,000. What the sense is that, oh, this is our total asset. Every other element, what fraction does it hold of the total? And the sense is that those ones that will have huge percent, for example, our non-current assets is 58%. It is not alarming anyway, but if you come and see, like, say, inventory, merchandise inventory, that's the things we buy and sell. Let's say we buy and sell tomatoes, and we know how perishable tomatoes are. Then we calculated this, we did this vertical analysis, and we saw that inventory, the tomatoes that we have in our warehouse, is 70% of our total assets. That is quite dangerous, because it means that the tomato sales is not going on. We have so much unsold at the warehouse, and given that tomato is highly perishable, that kind of statistic is alerting us to a possible danger. I don't know if you get me.
Yes, please, I get it. Thank you.
So what we said was that every other item, all of these things are items, every other item in the statement being compared to a base item, and the base item for the balance sheet or the statement of financial position, the appropriate one is the total assets. If you are doing for the income statement, the appropriate base item has been the sales revenue. So you want to know how, for example, your expenses compare with your sales revenue. So maybe my advertisement expense is 10% of my sales revenue. This is 1% of my sales revenue. That kind of information gives you some insight as to what is happening and what decision to take. Is that okay? I hope that is okay.
Yes, please.
Okay, thank you very much. So any other questions? Any other questions? Okay, let's proceed with ratio analysis. So we have done horizontal analysis, basically comparative financial analysis. We have done vertical analysis, also known as common size financial statements, common size analysis. We have done trend analysis. Let me say something small about common size or vertical analysis. Another instance where that kind of analysis becomes very useful is where, let's say, we are comparing two identical companies. It's not the same company. What we did is for the same company. Two identical companies. One is reporting its figures in, let's say, millions. One is reporting, for another one, the figures are in maybe thousands or whatever. Such kind of presentations will not make it too reasonable for us to compare the two companies directly, so that we pick company A's revenue, we compare companies B revenue. We cannot make any logic from that analysis. So you might want to common size their financial statements, reduce the financial statements to common size financial statements. So fine, regardless of whatever value and however you are reporting it, let's say your inventory, we divide it by your own assets, so we are common sizing it. In that case, we can now say that we have put all the companies on the same level, and now we can compare. That's one big use for common size financial statements.